Hey there, everybody. Thomas with the Basecamp Trading. It is Tuesday, February 11th, and today we're going to talk about confluence and confluence in trading. So before we dive in here, though, make sure you hit that like button and subscribe if you have not already done so. That way you can be alerted whenever we send out new videos. There's also a little bell I think you got to turn on here on YouTube that'll ping you whenever there's a new video uploaded. But with that being said, the other day, yesterday specifically, we talked about long entries in the NASDAQ and the S&P and the other indices and how we expected them to climb through the afternoon. And one of the things I want to point out here that we look for when we're trading the indices specifically, as well as other markets, is confluence between correlated markets. So if we have a setup that's triggering, for example, in the NASDAQ, and we also have a setup that's the same type of setup triggering in the S&P at the same time, that's a higher probability trade than if it's just one or the other, because we have correlations. These are positively correlated markets, and the more things we can get pointing to the same direction, the higher the likelihood of following through. So for example, yesterday we had this micro trend here on the 120s in the NASDAQ, which is this trend line here. So we had gone expansion up, compression sideways, draw a trend line connecting our pivot highs. You also had well-defined resistance up here at the highs. We broke through that, and while we were triggering that micro trend on the NASDAQ, if you actually take a look at the S&P, we had the same type of setup. Now, it wasn't as sideways clean compression as the NASDAQ was, but it was also very strong micro trend where we had gone expansion up, compression back down. All right, draw a trend line connecting our pivot highs. You can see we hit it 4 different times. Once here, once here, once here, once here. We were breaking through the trend line to the upside on the S&P as well. So we had bullish signals triggering simultaneously in both the S&P and the NASDAQ. So that confluence between those two correlated markets gives us a higher probability long than if it was just one or the other. Okay, now this same type of confluence that we're talking about, where you have multiple things lining up saying the same direction, this is also how we identify the highest probability trades. The more different signals that we have triggering at the same time, the higher the likelihood of a winning trade. So for example, a breakout like this is fine. Okay, a trend line break, that's good. All right, it's a decent win rate, but that's just one signal. At the same time that we had this trend line break on the 120s, if you look at your 240-minute price chart, you also had nice long hammer, both on the 240s over the night session and then again during the day. So we had hammers also leading into it. Plus we had what we call a daily bullish inflection on the daily price chart that was suggesting prices were going to accelerate higher as well. So we had confluence between setups and between correlated markets. So when we're looking for the highest probability trade, look for more setups agreeing on the direction. The more setups we have, the higher the likelihood of following through. And that's the answer I give to people when they say, Thomas, what's the number one setup you look for? There's not a single setup that I think is better than any other one. It's the confluence between setups and time frames that lead to a high probability win rate. All right, but that's it for today. I hope it helps. Once more, make sure you hit that like button. And until next time, everyone, happy trading.